Cruella de Vil is my Hello, welcome friends and listeners and viewers. We are back, episode 101. We just talked about behind the scenes about 101 Dalmatians, the movie that I liked very much. And I just told the guys I am a fan of Cruella de Vil. She's my spirit animal.
Checks out.
And exactly. So
And what'd you tell Tyler if that was the case and he was a Dalmatian, what would happen?
he would be a fur coat by now.
Oh, wow. Okay.
No, all good guys. So we all love each other. So for
Some days more than others.
for our viewers, you might have seen
And listeners.
and listeners, a handsome new man in the group. John,
Thank you.
welcome to the pod.
Wow.
Are we done? So John Ingham,
Just giving
our
me the
investment
quality deserved.
analyst. Let me do my hosting here.
Okay.
Our investment analyst with GI for 4 months. No, 6 months. 6 months. Four-ish,
Yeah.
whatever. Who takes it that close?
Yeah, exactly.
Anyways, you were with Gradient a little bit longer than that. You were at a different department before, so you know the firm. So John, tell us a little bit about yourself.
Yeah, before coming to GI, I was with K Central for about a year, and then I made the transition over here. So that's kind of
Do you like it so far?
yeah, I do.
Yeah.
It's
What
interesting.
else can you say now, right?
What was that?
Well,
What
you
else
can't
can you
say-
say
Can't say
now?
anything bad.
Yeah, can't say anything.
No.
No.
another little known fact about John and I live far away in a city that's
you
not
grew
very
up in the
big,
in
and
the same-
John went to the same high
Mhm.
school as my kids. So
Yeah.
small world. I don't think anybody else in the company lives in that city. So
Mhm.
Nope.
little
Pretty good.
You're an Elk River guy?
Yep.
I guess I never knew that.
there
Yep.
you go.
Learned
Been there
something new.
since I was 2, so
Wow.
most of my life.
Nice. Well,
Nice.
welcome aboard and
Thank
welcome
you.
to your first podcast. And don't
Yeah.
let Lisa and Tyler kind of run you over too bad here.
Well, I'm a nice person. We'll make it a good one. Other than that, the old guys are back: Keith, Tyler, and Lisa. So the usual staples, but we have some
New exciting,
new
yeah.
exciting blood in here. So, anyways, because it's Sean's first time, obviously he knows the pod because he was a listener first. But you
Like and
know
subscribe,
that-
right, John? If you haven't.
You know that we start usually with the 2 truths and a lie.
Yep.
And you
yep.
need to spot the lie. So I thought because we are on or already started earnings season, which is always obviously a very exciting time for us in the team, get some updates on how companies are doing and how the economy is doing and consumer. So I did an earnings edition today. So listen up. A, European companies are not required to report their earnings quarterly since 2003. B, if true, this earnings season would mark the 6th consecutive month with double-digit earnings growth. Or C, full year earnings growth for 2026 is expected to be around 18.1% at the moment. So, John, let's start with you. What do you think is the lie?
All right. So
I'm sneaky.
Yeah.
For A, Europe kind of leans more into the regulations, so I'm thinking that one's true. That one's true. That one's not the lie. Or no, actually, I'm thinking that one's the lie. But I remember seeing something about in the ballpark of 18% earnings growth a little bit ago, so I feel good about that one. And I know that earnings have been pretty consistent over the past little bit here, so I'm thinking that I'm going to go with A for the lie.
Okay, good reasoning. Yeah. Keith, what do you think?
Well, yeah. Maybe the new guys actually get right. I agree. I think 18%, I'm pretty sure that's correct on, which is eye-popping number for the C, on the earnings growth, which again, that's a monster number. And then I do think I read the other day that this is the 6th consecutive quarter of earnings growth. I think it was call out was double digits. So I'm saying that's true. And then you and your European trick questions, I'm going, that's false.
Okay.
I'll leave it at
Tyler?
that.
Well, European companies are not required to report quarterly earnings. They'll do trading updates.
Mhm.
So they'll do it at fiscal year end, and then they'll do it halfway through. So they do a lot of semi-annual, and they'll do a trading update in between. So I know that's true. The one thing I don't know what she's doing is it since 2003.
Yeah, there you go.
That's I know I just did a presentation, and 18.1% is the earnings growth. I guess I'm not sure if this is the 6th consecutive month with double-digit earnings growth, so I'm not 100% sure on that. But knowing Lisa, she probably monkeyed with the 2003 number, so I'm going with A.
I think that's exactly what happened too. By the way.
Unfortunately, I didn't get you this time. It's A is wrong, but the explanation was only correct from Tyler. So again, like European companies are not required to report quarterly, more semi-annual. But it's not required since 2013 and not 2003. So that was my tampering here.
You, Lisa, all three of us got it right. Nice job, John. First time.
Yep, first time and right. So let's stay with earnings season. I mean, we just started. Banks are traditionally the first one starting, and Wall Street analysts are expecting Q1 2026 earnings growth of 12.6% as of Friday last week. So that's just for this quarter. It came down a little bit. It was a little bit higher at 13.2 a couple of weeks ago. So we came down a little bit, but it's still very strong. It would be again the 6th consecutive month of earnings growth quarterly. And when you scroll down a little bit, our viewers cannot see it, but that's actually the analyst expectations on a quarterly basis versus what actually happened. And at least the chart goes back to the first quarter of 2023. And the interesting thing is, usually we say, okay, Wall Street analysts are usually a little bit optimistic. That's what we said when coming into the year with 18%. We started with 16 and we bumped out to 18% earnings growth expectations for the whole year. Usually that comes down a little bit. In this case, on a quarterly basis, the actual numbers outpace the analyst expectations every single quarter since 2023, which was astounding to me that this is the exact other way around. And when you scroll up a little bit, Tyler, again, thank you. So what do you think? Are the quarterly, first of all, the yearly and the quarterly expectations, are these too high, too low, given the other quarters before that actual reality numbers came in higher, or what are we thinking? Keith, I start with you.
I'll start with the full year and kind of my thoughts on 18%. That is absolutely eye-popping. I don't remember, I'm the old guy here. I don't remember seeing a number that big that we weren't coming out of a recession or some kind of, the great financial crisis where there was a snap back that the numbers were that high. That's a big number for an economy that's kind of humming along, which is kind of that 1.5% to 3% GDP, just kind of steady Eddie, I should say, and not, just kind of normal business. But to accelerate to 18%, that's a big number. So, yeah, I'm surprised. We're earnings season so far. We'll get into it here shortly, I'm sure. First few companies reported seems to be pretty good. And then last quarter, if we back up, I think the expectation going into the quarter were for about 6-7%, and we ended up at 11-12%. So it's and I'm a little surprised in that stat that normally this numbers come down, but they haven't. They've actually gone up the other way, and there's a lot of good reasons for it. Companies getting more efficient. You had the AI, surprising to the upside, which is a key driver. Now the market's starting to broadening out. So other companies are participating. So yeah, I'm excited, and I think this all goes back into a lot of questions we get from advisors and clients, and the news flow and the seem almost like panic, like, oh my goodness, the markets are pulling back. But what we do is we look at company fundamentals, which is earnings, and they're relatively really good. So I think that's the focus, and that's why markets feel like they're down 10% in reality. The market, the S&P year to date is slightly up, which again, if you ask a lot of people, I don't think they'd think that.
Yeah.
No.
John, what do you think? What is one sector that you're most excited for to see this earnings season?
Yeah, I feel like the one that we always look forward to is the banks, just to get kind of we see all the headlines about inflation and oil prices, but the banks kind of give us the true look into the consumer to see their health. So that's one that I think is good to keep our eye on, particularly this time.
Yeah. And that's a good segue because banks started already. Not all of them are, but the big boys, so to speak, like Goldman, BlackRock, J.P. Morgan, Wells Fargo, Citi, they already reported and gave us a good kind of insight so far. So, John, what are some of the key takeaways or any aha moments or any highlights so far?
Yeah, I think it's been all good news so far. Bank of America had a good report this morning. JP Morgan was beats, although they did see a little bit of a pullback. But as far as for consumer health, I haven't seen any red flags yet.
Tyler, what do you think? Some highlights so far? Especially looking at the consumer. I mean, we talked a lot about, we discussed that last year, last episode, that we talked a lot about the consumer over the last 1 or 2 years, the K-shape, higher income versus lower income. Anything with the banks that you specifically were looking for?
Not necessarily. I mean, one thing that's been interesting is the trading income. I mean, the problem with these money center banks, and not necessarily a problem, but they're the different areas of their business, their revenues ebb and flow so significantly. And what I thought was interesting, like last night or yesterday, Citigroup talking about their fixed income trading was really what drove their revenue, which I don't know the last time that we've ever really talked about fixed income being the revenue driver for a money center bank.
That's interesting because for Goldman, this was more the boon. For them, it was more the downside, where the stock was down after a great report. But their fixed income trading was
with the money center banks. You get these ebbs and flows of trading or investment banking, or right. There's not a consistent winner, right? We oftentimes look at net interest income or net interest margin to figure out what is the bank actually making. But with the money center banks, a lot of times it's what's actually driving the revenue is like the ebbs and flows of these different business lines, which is nice to have a diversified bank. And I think over long periods of time, it probably gives you a better outcome, right? Rather than sticking with like a U.S. bank, which I like U.S. Bank. I think it's a good stock from the loan growth and the way they control costs. But you also have other lines of revenue outside of what U.S. Bank, the regional banks traditionally make, with the investment banking, with the trading. So I like them. I think the reports were good. Wells Fargo was pretty decent. So generally speaking, I think we're off to a good earnings start. We're not hearing a lot about, to your question on the consumers, we're not hearing a lot about provisions for credit loss. Like they're not increasing more than expected, which is what you would start to hear if banks are concerned about consumers. They're going to start to take those provisions ahead of time so that later on down the road, they know that they have this bucket of money that if it does default or consumers don't pay their credit cards or loans, we're not as worried about it. So I think it's showing that the consumer has been resilient despite all the concerns over their spending power and how much loans they have and credit card debt they have. And here you go.
Thank you.
I'll let you control it.
Sorry.
For listeners, we look at a screen once in a while, and Lisa wasn't at the control, so she's like,
I was not happy with his controlling performance. So
bossing
I
Tyler
take it
around
over
behind
now.
the scenes here of like, what do you need to do here, Tyler?
So, anyways, I think we're off to a good start. Consumers remain healthy-ish, right? I still think there is that K-shaped form to the economy, and your higher income are still spending, your lower income are probably not as much, especially with oil prices like we've talked about the last couple of weeks. But generally speaking, from the bank perspective, everything looks good so far.
Yeah, the one I'd like to call, the biggest of the big is JP Morgan, beat across the boards, very healthy commentary, his earnings, revenue. And then Jamie Dimon's comments are always interesting, right? Because I think he's definitely
he's like the Warren Buffett,
most outspoken, well listened to, very thoughtful, but also very kind of a little bit more conservative, dour on
always,
right? So then he said, consumer very healthy,
but
employment very good. All the stuff is very, very good, right? Which is what we talk about, right? He basically called out people are working, they have money, they're spending. That hasn't changed, which is great, for the overall economy. He pointed out to basically the geopolitical risks, the risk uncertainty, which is always the case. So there is some things, and again, that's what the market worries about as well. But if you go back the last couple of years, it's been remember the hurricanes coming. And so he's always, which again, I like in a banker, right? Because you want a strong financial system. So I think he does a fantastic job, but I think his commentary is always a little bit more on the
pessimistic.
But what I found interesting was we've talked on the show about it's not about what they say necessarily, it's about their change in tone.
Yep. Or expectations.
So
right,
to your point, like Jamie Dimon has always been negative on consumers, the economy for the last 2 or 3 years, hurricanes coming, and also now he's like, oh, consumers are good.
Yeah.
So it's interesting seeing the difference, because someone like that who has that much insight, because however many thousands and probably millions of people use JP Morgan Chase as their primary bank, and all of a sudden he's probably seeing the flows of the average deposit, and he's making a shift in his overall stance, which is always what is more interesting to us, I think, than actually what he's saying.
Yeah, no, it's good. I mean, you're exactly spot on. It's interesting. I think you read tea leaves, he's a little more positive than, but
maybe that's a bear signal.
Maybe, but he still put the caveat of the unknown risks and stuff like that. So
I mean, he's been negative the last 3 years, and we've had 26, 25, and 17.
Yeah, which again, I like that from a bank perspective. If you lived through the great financial crisis and how the banks were kind of doing some little I call monkey business, that it doesn't seem like there should be any part of that. I mean, there's this private credit issue that we can talk about, not talk about, that certain they're players in it, but relatively small.
His job is risk
manager. Yep.
Right. Like, so he's always gonna be pessimistic.
And for the biggest bank, that's what I like.
Yeah. What are their daily flows, like 2.1 trillion or something, somewhere in that ballpark?
Yeah.
On a daily basis, flowing in and out of JP Morgan.
It's even more than Lisa's. Has at home in the bank.
A little bit higher. Does not give much though. Anyways, let's that was a good segue, because let's stay with the negativity for a while and with the pessimistic stance, because we heard, I mean, the banks reported very well so far. Consumer is resilient. Delinquency rate not much higher. It seems good, right? At least resilient economy, business. How earnings are expected to grow, but the consumer does not feel that way. We got like a consumer sentiment report last week. The University of Michigan, it's one of 3 main ones who report. And it has a history of over 70 years doing these surveys on consumer sentiment, how the US consumer is feeling. And we just got the lowest number on record ever. In its over 70 years history, the consumer, basically the mood is off among US consumers.
Low is bad, right?
They're really feeling really bad. I mean, there's a lot going on, right? We have high energy prices, oil, all of that, policy uncertainty, market volatility, obviously, over the last couple of weeks, specifically. Inflationary pressures due to higher energy prices are expected and already flowing in. So there is no shortage of concerns. But what surprised me, though, is that it's so low now. And given like the 70-year history that they are doing this, I mean, we have the great financial crisis in there. We have COVID in there. I mean, remember back in the beginning of COVID, we all thought we're going to die the next day, right? There is the dot-com bubble in there, right? There's like some really, really bad times in there where they did the survey. But now it seems it's the worst report on record, which kind of threw me off a little bit. It's like there were way more, worse times than we are living in right now. So it seems a little crazy to me. So John, I wanna have your insights as well. What you think the reasons are for this? Why is the US consumer right now feeling so bad? What could be reasons that you think of?
Yeah, I think the gas prices are obviously the most visible commodity price out there. You see them every time you drive by. So I think that can obviously lead to a little bit of a overstatement of how bad they are. And then I do think a lot of it has to do with the polarization and just how either you love them or you hate them when you're talking about this regime or this
regime.
Sorry, this administration. And it's
careful, John.
Yeah, it's kind of, I think it can kind of lead people to have that very pessimistic outlook on the future. So that's kind of what I attribute most of it to.
Keith, what are you thinking?
Yeah, I'm more in the camp of what you talked about. I'm surprised that all these things have been, in my mind, way worse than the current situation we're in.
I mean,
the sentiment
maybe another
surveys,
caveat. Now it's the low point. The prior low point was June of 2022.
Yeah, high inflation, right? So that's what it's tied to. So the gas
still
prices,
worse than
But I mean, the
all
great
of
financial
that.
crisis. I mean, that was a nightmare for people. You're working, unemployment. COVID certainly was a nightmare. And maybe they didn't do any surveys. That's why we didn't see a worse number, because I can't believe the situation now would be worse than 15% unemployment. The world's going to end. You know, death's right around the corner for everybody. So that surprises me. Again, I think it's, John kind of nailed the big parts, is it's oil prices and gas prices.
Which is interesting, because in this over 70-year history, there is also the oil price crisis in there.
Well, even now,
of the 70s. So it's like,
we've gone from $3 national average to $4. I think under Biden, when that inflation in 2022 was at over 5. So that's why it is.
Right.
Again,
it's kind of a little weird here. So
yeah, I would take this, all surveys. You know, this sentiment one always kind of gets me. I don't know what the sampling size either. We'd probably have to dig in more of. And maybe
and
this
the
last month,
demographics, what exactly where they're in the U.S.
The polarization of what's going on. Maybe that some of those people end up filling out their survey more than others did, and maybe that's skewing it, because it's hard to believe in it. You know, that the situation we're in currently. Again, you can be negative and moods off, certainly for valid reasons, but to say it's worse than some of these other events that you've met, I find that hard to believe.
Well, one thing could be is that with these other events, it could be the worst was over. They hit so immediate. By the time we got these sentiment reports, they might have been thinking the worst is behind us, when with this, it's kind of an ongoing process. So,
well, the interesting thing is there are 3 main reports out there. And all 3 kind of look at a little bit different things. So their semantics are a little bit different. With the University of Michigan survey on consumer sentiment is more forward-looking, so more what they are thinking about the future. And then there's others that look more about, okay, the labor market specifically, what jobs are doing, inflation specifically. So it's they all do look at a little bit different things, but that one is a little bit more forward-looking. But yeah, that could be, I mean, timing could be. But Tella, what do you think is timing when the survey actually gets released or asked? Is that?
Well, to your point, so the U of Michigan survey is more forward-looking. So I think a lot of it has to do with, I think a lot of it is the prominence of AI and social media, to be honest with you, because the algorithms of social media put you into a vacuum. And so if you're right or left, or if you don't like this or you like that, like, it just continues
amplifies it for you. Right?
Yes. So I think that's part of the issue. And then you start to think about AI, and not everybody's seen the Centrinian report, and I'm guessing most consumers haven't read it, but you hear the sentiment around AI and the future prospects of your job and the potential replacement of your job. And I think AI and social media have really caused this. And then you tack on the uncertainty of our geopolitical risk. And I mean, love him or hate him, Trump is a wild card. He may have this master plan. Like last night I was scrolling Twitter and saw
X.
X. Still hate that.
Well, I'm just make sure Elon's getting his
right, but there. Like there was a picture of all of the tankers going over to the Gulf of America, right? And maybe that's his master plan, but also you don't know if it's AI generated. You don't know, like, the uncertainty around everything with what is AI, what's not. You're on social media, you doom scroll, and you're in this vacuum of stuff that you're just finding. I think that's probably the bigger issue right now than the actual, like, feeling over the economy. I think it's more that there's just uncertainty around everything right now.
It's funny you say that, because bringing up Twitter, X, whatever you want to call it, I'm not on social media, but in the last 3 months I got on X just because of all the news flow breaking. And then it's absolutely astonishing how much all these headlines, I read both sides, right? You just want to be well informed, but there'll be a story and then you click on it And it's like, oh, it sounds horrible. Like, is it AI generated now? And then you go to the Grok, which at least kind of puts some kind of reference points. And 85, 90% of the time, every time I click on, is this story true? It's not. Or old picture.
Yeah.
Like, I don't know how many people even click to that next, the Grok part to actually see if that's true or not. So I'm like, there's so much misinformation out there.
I think that's the bigger issue.
Absolutely insane.
And then if you go to X, leans more one side. Threads, which is Meta's version, leans another side, right? So like and you just get put into a vacuum.
Yeah, it is astonishing.
So I think that's more where this sentiment is, where you're seeing these record sentiments is more about the uncertainty and vacuums that you get put into rather than the actual feeling over like, what is the economy doing?
Do you think that can improve then? Or is that we are just going to automatically be a reset lower now? Because I don't think that goes away, right?
Lower. It doesn't go away.
The interesting thing is also what I've read the other day is like among Gen Z, the youngest generation now in the workforce, and we have one Gen Z in the room.
John, are you a Gen Z officially, or don't you know?
Yeah, barely.
Yeah, right. But he's an older Gen Z, so to speak, but still Gen Z. They're usually, more in the beginning or, starting years of their career. That they especially about all of that sentiment that's going on, and especially around AI, that they feel or their perception about AI has changed dramatically in the last year. They are said to be actually in the beginning the most adopters, the highest adopters of AI, the most heavy users. And over the last year, their sentiment towards AI turned really sour, right? They turned less hopeful.
Taking their jobs.
Yes, right. Because they're realizing basically, hey, is an more entry level, they're taking the jobs, right? And it's like weird, but. So the sentiment has shifted completely from AI prospects and how they are viewing AI, if that would be helpful for humanity and going forward or not. So John, I'm interested because we have Gen Z in here. Has your perception changed around AI over the last year as well? How are you viewing it overall? What's your sentiment around that? And you have more insights into that, obviously, because it's also part of your job, right?
Or your friend base, right? Probably.
Right, yeah.
Yeah, I mean, there's definitely been that negative shift in my age group to how they view it, but from how I view it personally, it's not going away. So it's either learn to use it to improve or kind of be left behind. You can't, you can't have them just stop producing it.
So you think like even if the sentiment like shifted negative, and younger people start to don't like it as much, but they're forced to use it and to utilize it and to get used to it.
And I believe there'll be like a learning curve. Obviously, there'll be a period where it's hard to get jobs, but then as everybody kind of adopts AI, there'll be new jobs created and new opportunities. So I think we're kind of in that period of strife right now where it's kind of the worst outlook on it right now and the worst sentiment from my age group because they're probably the most affected by it.
Yeah, I think that's well said. I think you covered kind of what I think that is the sentiment, right? These are replacing our jobs, but I think you're exactly right. If you can adapt and kind of jump on board with the changes and kind of there will be new jobs created and kind of I think we are in kind of the bottoming kind of unknown process. I mean, some jobs are literally going to go away, but there's other opportunities. I think you're right on it. And I think you're got a good attitude for it.
And also to go back to that consumer sentiment, because it's so low and we kind of try to figure out what the reasons could be for that. And I found an interesting chart here that kind of looks at the University of Michigan Consumer Index when there's high points. So when people feel very, very great, when people feel very low, which again, we are at the low point right now, and what the subsequent 12-month forward S&P 500 returns after that. And the interesting thing is when sentiment is at the low points, that means usually positive returns over the next 12 months versus they are at the high points. So consumers feel absolutely amazing, usually tends to be more negative or more muted. So, which is interesting because consumer sentiment could serve as a contrarian indicator. Obviously not in and itself, in conjunction with other things. But I think it was an interesting caveat to look at it like that. So Keith, what are you thinking about that?
Yeah, that doesn't surprise me. I mean, it's kind of a contrarian indicator, just as stock market generally likes to, in theory, looks 6 to 12 months ahead. It's kind of pricing in some of this news. And as more and more of this gets negativity goes out there and you starting to feel worse. A lot of times the stock's already been kind of selling off. And when everybody kind of admits to it, it's probably the bottom and things go better. Vice versa, like the fear of missing out trade. Sentiment's just great. Market's been just rallying. I got to get in, and you could be like the last dollar in as well. And it's all of a sudden something, slows down, and all of a sudden then the markets kind of sell off. So yeah, it's a good chart. I mean, if you could see it, it's the peaks and the troughs are coincide with sentiment turning, which makes sense to me.
So it means, Tyler, with the same logic, when we trust history, means that there are good times ahead.
Yeah.
You left Tyler speechless almost.
I left him speechless. That never happened before.
I mean, theoretically, yes. I mean, the thing you have to separate is, again, there's a difference between the market and the economy.
Yeah, right.
And so when consumers feel like crap, we as Americans, even though we feel like crap, we still like to spend our money because that seems to make us feel better, right? So when we're feeling like crap and we want to buy stuff to make us feel better, that tends to lead to higher earnings growth.
I mean, it's crazy, but that's exactly
So
that's exactly what happens at the moment. I mean, the consumer remains resilient, and we can talk all day long about the K-shape, about what consumers keep spending. But the higher income consumer keeps spending, yet sentiment is so low. So we feel like crap, but we still keep on spending.
In the economy, the other thing you have to remember is every consumer is one for one, right? So you count as one, you count as one, you count as one, I count as one. The stock market, it's not one for one. So depending on who's buying stuff, that consumer might account for 0.2, 0.3, another consumer might count for 1.5. So if that higher end consumer continues to spend and feels good about themselves and continues to do what they normally do on a daily basis, they account for more aspects of the market, but they only account for one in the economic data. So if you're on the lower end of the consumer threshold, you might account for 0.2 in the market, but you account for 1 in the economic data. So we have to remember that, because I think that's a really important aspect of the difference between the two. But based on your logic and the charts and history would suggest that when consumer sentiment gets this low, yes, there are good times ahead for the market.
There you go.
John, any more notes to this?
Yeah, it might be kind of tied to inflation. When we see inflation, the business cycle is usually in an upswing when we see inflation pick up, and sentiment might have kind of that inverse relationship to inflation. That might be a reason why we kind of see the contrarian indicator.
Yeah, good point. Anyways, so that was it for earnings season and all the sentiment out there. But I want to stick a little bit more with AI, because I heard some news yesterday about Meta, that Meta is introducing an AI twin of Mark Zuckerberg, only for the reason, and Meta has about like 79,000 employees, and obviously he cannot, be present everywhere. But they're interested in their employees having a little bit more time with the CEO. So he's introducing an AI twin of himself for their employees to bond with, to chat with, to see, so they feel a little bit more connected to him.
So you can have a hologram of Mark Zuckerberg.
I don't know if it's a hologram. I think it's a chatbot to begin with.
It's a bobblehead that talks to you.
It's a bobblehead, yeah. Probably at some point will be a hologram, but for now it's a chatbot and should react like him. It's fed with and trained with his attitude and his, how he usually responds. I don't know if anyone of his employees asked for that. Probably not.
There's a lot of like, oh, Mark, you're the best.
Yeah, right, exactly. I was like, I don't know how much reality and honesty he expects from these chats either. But what I want you to ask,
that's a stupid idea.
That's a stupid idea,
Okay.
yes. But what I want you to ask is, well, is it time for AI Binger then? Because we also have, we actually have a Binger twin already. It's paper binger, and it's usually somewhere stored, and it's usually used to scare people.
Makes its rounds every
It
now
makes
and
its
then.
rounds every now and then, and paper binger, which is basically a huge kind of cutout of binger in life size as a paper stand model, and it usually pops up somewhere at a desk or whatever to scare the hell out of people when he's not around. So do we need that? Are we asking for that, John? I'll start with you.
Yeah, there you go.
The newest unbiased member of the team.
Maybe we could have AI Binger fill in for Fridays since Binger's not here.
Yes,
there you go,
that's
John.
a good idea.
Nice.
Okay. Keith,
Way to stay safe on that one.
Yeah.
It'd be kind of interesting since we got the paper binger, attach some tech to it. So as he walks by, AI binger kind of,
we can press a
hey,
button.
what are you doing? Any more questions? Or then he can get maybe asking you questions as you walk by.
Yeah.
Hey, Lisa, how's the social responsible doing? Or precious metals.
Exactly.
And you can tailor to whoever's walking by. That'd be great.
Gives a lot of comfort to know that you can.
He's still watching on you.
Yeah. Tyler, what are you smirking here? What are you having on your mind?
All I picture is a hologram binger just with the finger point.
Yeah.
But the interesting thing is we can now test if Binger actually listens to our podcast, because if he does not respond to that discussion, we know that he is actually not listening to it. So that's a kind of a test for him in
thinking
itself.
Is maybe he doesn't listen to this episode.
We'll see.
So you can be honest, Tyler.
Yeah. That would be.
My guess AI Binger would be asking a lot of questions.
Yes.
Yeah, I guess so.
He likes to ask people questions on the spot.
Yeah.
And one quick question to close it out. Is there any person, dead or alive, that you would like to have the opportunity to chat with? No matter who it is, no matter if the person is dead or alive, famous or not, is there one person out there who you would actually find beneficial to have a talk to? Tyler, I'll start with you. Let's go to rounds.
Like for like actual knowledge purpose.
Yeah, and just asking and chatting, whatever. Personal questions.
I feel like it'd be interesting to
business.
have like a Einstein or Nikola Tesla or someone like that.
Mm-hmm. Oh, that's a good one. Keith?
Yeah, I mean, those are that would pretty obvious high on the list. I don't know, maybe someone like a pope or a king from old times, just kind of how the world was developing, kind of the times back then. I think would be fascinating to hear about the insight on that.
Yeah, I'd probably go the same route as Keith and go pretty far back to kind of see just how much of history we actually got right.
Yeah, for sure, right? That would be
kind of the actual viewpoint of it.
Yeah.
A lot of times you just don't know. They kind of fill in. I listened to a podcast the other day that's something about the rise of history, I think, or something like that. It's kind of same type of concept. Like there's a lot of like, this is the truth of history back then. All of a sudden, 6 months later, is another revised version because
we dig something out of the ground that kind of changes
like an
the
Egyptian
view.
King.
Yeah.
Something like
Tutankhamun.
Yeah.
Or even like new dinosaurs.
How about you,
have
Lisa?
you not
What do you got?
discovered a new dinosaur lately?
The caveman? Is that what you're going to go AI in?
I go not as far back because obviously the person needs to have the capability to actually chat with me. So probably not the caveman. But I would also lean. I'm a huge history geek. That was always kind of I like that. Different, time frames from the past. So I don't know if I know exactly what specific person, but somewhere from past. To kind of ask what was life back then and if we really got it right or not.
Sure.
So, and for our listeners, leave us in the comments what your person would be to chat with from alive or dead. And with that, thank you so much for joining me. Welcome, John, to the pod.
Thank you.
Oh, God, Tyler. Anyways, like and subscribe, and we are back next week. Next week.